Yeah, no, and I think that's fair. I think, from my perspective, when I say that what's happened before here has never happened before in history, I'm really talking more about the correlated drawdown of equities to treasuries, in particular 10-year. And I know this because I've tested this and I've got data from the Center for Research and Security Prices from Chicago. Booth goes into one of the papers that won the 2015 Founders Award. But if you were to look in the 70s, as much as everyone, when they think about stocks and bonds, keeps talking about the 70s, you would not find a sequence in the 70s where you've had that incredible correlation where stocks are drawing down just like treasuries are as yields are rising. It's hard to know in the 40s because there really is no data that goes back that far in time because there wasn't necessarily up to date, accurate total return way of kind of backcasting how bonds behaved back then. Now, there's another interesting aspect of this, Lynn, talking about the 40s and the 70s, which is there was a structural change in the way the monetary system worked once we got off the gold standard. And I do wonder if that factors into any of these types of analogies with the 40s, because even though everything you mentioned, of course, is unequivocally true and there are parallels there, that seems like it's a pretty big differentiator to even understand that make that terrain parallel, so to speak.
The main one that changed there was the structural trade deficit situation. So I factor that heavily into my analysis as it pertains to this current Eurodollar, petrodollar system compared to the Bretton Woods gold standard system, because now the treasury is at the heart of the global financial system rather than gold. That's the biggest difference. And so that's been a strong catalyst to force the U.S. to run these structural trade deficits and to have these, the positive flow of foreign capital into U.S. markets. And then our subsequent reliance on that engine continuing, and the harms that come from having that engine continuing, because it's not a purely one-way street. Basically, we kind of draw down our manufacturing base to some degree in order to have these stronger capital markets, which is, I think, a contributor to the rising populism that we're seeing today. Going back to the Bretton Woods system. Although that was a large change, one thing I would actually argue is that the financial system changed substantially decades prior to that. And that was actually the more fundamental change. So by the time you got to the 50s and 60s, for example, even though the U.S. was officially still on this international gold standard, gold was not a constraint for bank lending. So money supply was growing dramatically, despite the fact that gold in the vaults of the Treasury was declining that whole time. They're basically banks. They never had a pile of gold that they checked and said, "Do you have enough gold before you can make this loan?" They didn't have that constraint at all. So you already had a complete separation from the whole process of money creation and gold, and that got marked to market in the 1970s. But that was already decoupled for decades leading up to then. Whereas I think the more fundamental changes happened decades earlier, when you moved from free banking to central banking and then increasingly abstracted the gold away from the whole process. So gold went from the banks to the central bank and then went from the central bank to the treasury. And it just got removed from the whole money creation process, even when we were still on a gold standard. And that's part of the reason why we ultimately lost the gold standard, is because the gold was no longer a practical constraint on money creation. Even the foreign sector, foreign central banks could create dollars essentially by lending. And that's, the whole Eurodollar market grew around the gold market. And so you had this increasing number of dollars and foreign claims on dollars, and those were foreign claims on gold. And eventually the United States severed that connection. And so that was just marking to market a problem that was already in place for the, pretty much the whole duration of the Bretton Woods system. And so I think that that's an important distinction, especially as it relates to the differences in trade deficits between the United States and the UK. Like I said before, I think the United States looks more like the UK from the 1940s than it looks like the United States from the 1940s. So it factors in that way, but I don't think it really factors too much into the monetary and fiscal policy angle.
Okay, let's talk about the money supply versus supply chain disruptions as narratives that explain inflation here, because I've done a number of these spaces, and it seems to be it's always it's because of supply chain disruptions or it's because of money supply, but it's never a discussion around the combination of the two at the same time. When you think about what's happened with this inflation, would you give more weight and more credence to the idea that the Fed created it or underinvestment in commodities created it?
So I pick a third variable. I would say majority of it was the fiscal side, but I ascribe to the view that it's a combination. And so, when I analyze 150 years of data among multiple countries, there are a couple of key things that have to happen for persistent price inflation to occur. One is that in order to get a lot of price inflation, you need a lot of money supply growth. You don't really have environments where the money supply is just totally normal and inflation is just spiking for no reason, right? So you have to have a significant amount of money supply creation, either from bank lending or from fiscal spending, basically large monetized deficits. So that's what's one important variable. But then there are periods where you have a lot of money supply growth, but then you don't get a lot of price inflation. So then it begs the question, like, so what's happening there? Clearly, money supply growth is necessary but not sufficient in order to have broad price inflation. And so the other side is the supply side. Basically, how tight is our ability to expand our natural resource consumption or our supply chain situation? And so, for example, if you look at the UK, over that 150 years of data that I mentioned, the UK was already a developed country during that time. It had already, filled up its land. It was already kind of tapping into its natural resources. And so you had a rather tight correlation between money supply growth and price inflation during that time. Whereas when we look at the United States, there were two big periods where you had a big decoupling between money supply growth and price levels. One was in the late 1800s. And that was in large part because we had this whole untapped continent, really, to expand across, abundant natural resources, abundant cheap land. We were just tapping into new forms of energy. There's a rapid expansion in technology that made things cheaper. And that, of course, impacted the rest of the world as well. And so you had that combination of technological deflation and you had natural resource deflation. And so that was able to offset a lot of the money supply growth that the United States experienced in the late 1800s. Basically, we had resource abundance. And then another period of decoupling was in the past 25 years until very recently, where we had a larger than normal decoupling between money supply growth and CPI. And I think the biggest reason for that was the very strong trend of globalization. Basically, that money supply growth was offset by stagnant wages. And those stagnant wages were in large part, geographic arbitrage. Basically, there was a large pool of untapped labor in China and former Soviet states. And that, basically 1 billion people were joining the broad capital markets globally. And so kind of like having an untapped continent of natural resources, we had this like untapped continent of labor resources that we tapped into. And that was a very disinflationary force. And so in my view, both the money supply growth and the supply side constraints are two very important variables to look at. And that includes the supply side includes natural resources, particularly oil, as kind of the master commodity. I think a big reason why a lot of deflationists and economists were blindsided by this inflation is because they're too focused on the demand side. If you were to ask them a year or two ago, what's going on with commodity capex, they probably wouldn't have been able to tell you. It wasn't a high priority for them to look at. And so I feel like that's always a key variable of inflation to be aware of. And then two is the whole globalization versus deglobalization thing. And so as, China demographics are kind of tapped out, as we enter this more, Cold War type of scenario, I think that very persistent period of globalization is behind us, where it doesn't mean we snap our fingers and globalization's done. But I think that level of disinflation is behind us now. And that now that we're kind of in this more steady state environment or even partially deglobalizing, I think money supply growth is more likely to be met by inflationary pressures.